But let's talk about what's happening in both countries with two of our regular guests. David Rosenberg is founder and president of Rosenberg Research. Ed Devlin is founder of Devlin Capital and a senior fellow at the CD Howe Institute. Great to have you both with us. Nice to see you. Let's just start right now with the Canadian story, David, because we've got Tiff Macklem speaking and indicating over the last 24 hours that there is a likelihood that interest rate cuts could be in the not too distant future. How do you feel about the Canadian economic picture right now?
Well, I think that the Canadian economy is pretty well flat in its back. And that's not even an opinion. Unlike the U.S., where real GDP growth is over 3% year over year, it's 0.9 here. Let's think about that, 0.9 with population growth of 3.2. So in real per capita terms, the decay in Canadian economic activity is just continuing. And I think that what Tiff Macklem has to answer for is how he can come out in the press statement on April 10th and say that the Canadian economy has moved into excess supply, and yet the bank is keeping interest rates at least 150 basis points above the level that would be commensurate with an economy that's developing a disinflationary output gap. That's the question. I'd rather be there asking the questions, tell you the truth, because that's what I would want to get elected, David. I would want to know the bank's own estimate of R-star, okay, and it's of course it's a unobservable missing target, but they do provide a band. It's 2.25 to 3.25 for a nominal neutral rate. That's the neutral rate that would be consistent with an economy that's in equilibrium. The Bank Canada comes out and says that we're not in equilibrium. We're actually in an output gap, excess supply over demand. And yet they're pinning the overnight rate at 5%. Remember, the top end of the band for R-star is 3.25. The bank's estimate for where potential non-inflationary GDP growth is for the next 3 years is 1.8%. GDP growth right now is 0.9%. What are they waiting for? They certainly should not be waiting for the Fed. It wouldn't be the first time that the bank went on its own when economic conditions dictate that they should go on their own. But they should be striking now.
And Ed, in a week where we got an early indication that through the latest Canadian GDP numbers that there are some signs of a cool down. David talking about what he's seeing in numbers right now. Consumer spending in this country not keeping pace with our population growth. And whether that is people literally because of the interest rate environment not in a position to spend, or it's on their brain because of other or coming expenses, maybe mortgages rolling over. What do you think the path looks ahead for? David's saying, what are they waiting for? What do you think the plan from here looks like?
Well, you know, I'm probably like being a little bit of a broken record here, what I said before, but, you know, I think the bank probably waits a little longer than the market thinks before they start cutting, because it's just inflation. They got stung by that high inflation, and they want to make sure it's dead. But I'm with David. It is pretty much dead. And so and then they'll cut a lot more than the market thinks.
So on the inflation front, David, like as an example, it felt like, just to use the U.S. as an example, that they had seen a few months of reasonable trends on inflation, and then things kind of stalled out, and then all of a sudden the interest rate cut expectations totally started to change. Is there a possibility? I mean, it sounds like you don't think so, but after seeing some encouraging trends on inflation in this country, that we could stall out too, and that would be a bit of a pickle, let's say, for Tiff Macklem? No,
I don't think so, because the structure of the CPI is totally different. We don't have, I mean, look, I think it's a little bizarre that we have mortgage rates in the Consumer Price Index, and we've talked about that before.
Right.
But look, in the United States, 27% of the index is owner's equivalent rent, which is not even a price people pay. It's a question to the sample of homeowners. If you could rent out your house, what do you think you can get for it? And that's why, actually, if you put the U.S. inflation numbers on the same apples-to-apples comparison to Europe, where they don't have OER, even the U.S. inflation rate is 2.4, and the core is 1.9. But you see, Jay Powell will never talk about that. So you can't compare the two countries. The reality is that the Bank Canada indeed has an inflation objective. Well, the most important inflation number, and the Bank Canada knows this, is something called the CPIX, okay, which is the CPI that strips out the 8 most volatile components. Where's that running right now? It's running basically at 2%, right on target. You know, last week we got the retail sales numbers for Canada. Where is the retail price deflator in Canada? Where is it? Where is it? 0. There's no pricing power in the broad retail sector. So yeah, I'm not going to sit here and disagree with Ed. He puts, you know, I pontificate and he puts money to work in the markets. However, you know, if that's the deal, that we are deer in the headlights and we're going to carry out policy because we blew transitory a year and a half to 2.5 years ago, that's really sad commentary. And of course, the most important thing Ed said is that when it comes time to cut, by waiting so long, they're going to cut harder. So they're going to make the same mistake twice in different directions. And the longer they wait, the more they're going to have to do. The reality is that underlying inflation, properly measured in Canada, is already on target. And the economy is building up excess capacity. You don't need an economics degree to know that that's going to lead to further disinflation ahead. So they will be scrambling hard.
And go ahead, Dave.
No, in the next 12 months, they'll be cutting rates pretty aggressively, no matter what the Fed does. And the fallout will be in the Canadian dollar. But I'll tell you, we'll be begging for a weaker Canadian dollar to give juice to the manufacturing and export and tourism sector.
Yeah, let me ask a little question about that then, Ed, before we take a quick break here. So one narrative I've heard is because we are starting with our rates at a slightly lower level than the United States already, that there's already a bit of a gap there. And some people say, and David was kind of alluding to, you know, has our bank think about the American central bank. But if we start to cut and they're still not cutting, even if there's good justification to cut based on everything David's talking about right now, that quickly if you get to, I don't know, like 100 basis points of difference between Canada and the U.S. on rates, and you see that reflected in the Canadian dollar, that it opens the door to some other complicating factors, like what if we're importing inflation from the United States? I mean, how much of a consideration do you think ultimately that will be for somebody like Tiff Macklem?
Well, they have their models, and FX plays into it. It's, you know, financial conditions. So, you know, I think it was Mark Carney that famously said there are limits to which monetary policy can diverge. And he said that when the U.S. was at 0 and we were moving ourselves up to about 1 or so, right? So to your point, you know, if we start cutting aggressively ahead of the Fed, the Canadian dollar will weaken. It, you know, will be good for growth, bad for inflation, and it's, you know, and it's another form of monetary easing, effectively, or easing of financial conditions, and it just gets factored in like the way it's always been factored in. Unless David, you think differently, I don't think that relationship has really changed much over the last few decades.
Or is it less? At the end of the day, is that less of a concern, David, than a real deterioration in the economy itself from having higher interest rates?
Well, look, the first thing I think Ed is right that because Canada is a small open economy, the Canadian dollar bulk's very large in financial conditions. So that could be one of the things that when the bank's cutting interest rates that could mitigate extremely big cuts insofar as the Canadian dollar provides a lot of that stimulus. Mm-hmm. So there's a bit of a balancing act there. But firstly, here's what's different about Canada, okay? The unemployment rate here is 6.1%. Okay, it's not 3.8, and it's up a full percentage point in the past 12 months. And when you go up a percentage point on a 12-month basis, that's an 80% recession signal. So what's the Bank of Canada going to do? Are you going to operate policy based on what the Fed's doing? Is that your mandate? Look, the ECB is probably going to cut rates next month. The Bank of England's next move is going to be to cut rates. It's a matter of when. Look, you've got the Bank of Japan now snugging policy. We've got different, you know, we've got cross currents of monetary policy. What is the Bank of Canada's mandate? Now, in answer to your question before about is Canada going to feel inflation, it's kind of going to feel inflation from the U.S. Do you know that 100% of the deviation, and again, Powell didn't talk about it yesterday, 100% of the deviation in January, February, and March from what happened in the second half of last year, when nobody was complaining about inflation, it was coming down nicely, 100% of the deviation in the United States has come from insurance, health insurance, homeowner insurance, and mostly auto insurance, because the auto insurance companies are responding to the dramatic increase in claims. That's a homegrown situation. I don't even consider that to be real inflation. That's like a price level adjustment, okay? But you're going to tell me that Canada's going to import health insurance, auto insurance, and home insurance, because that's the inflation. The inflation deviation, all of it this year is from those three sources. And I'm going to tell you something. Out of all the Wall Street, Bay Street research that I read, nobody's talking about that except for me.
I just meant if the Canadian dollar is weaker, just the
we're going to need
importing inflation.
Well, think about the fact that the CPIX, which I will advise everybody who's watching the program to know that is really the true underlying inflation rate, is already on target. And we haven't seen the full impact. The Bank of Canada has acknowledged that the economy has moved into excess supply. That's going to put further downward pressure. So what's the bank going to wait for? How far will underlying inflation move below target before the Bank of Canada gets off its derriere and starts to cut interest rates? Keeping in mind what you said before, the debt service ratio in the Canadian household sector, is 15%. It doesn't sound like a high number, right? It is extremely high. It's at or higher than the level that presaged the last 4 recessions. So next thing, Ed and I will be on the show, and you'll be saying, geez, we're in a recession, and the Bank of Canada has not cut rates yet. Look, monetary policy is both an art and a science. However, they have over-tightened. And what I don't understand, and it's a little disingenuous, and it's not consistent, that you could have a policy rate that is 175 basis points above the high end of your range of R-star, at the same time that a month ago you told everybody that the economy has moved into an excess supply situation. Doesn't make any sense. That's the question he should be addressing today.